Have you ever wondered what kind of returns you can get from real estate investing? Maybe you've heard stories about passive income, cash flow, doubling your money, but what is realistic and how do you get there? In this video, I'm going to break down the kind of returns you can expect across different types of real estate investments, from single family rentals to syndications to mobile home parks. And by the end, you'll have a clear understanding of what's possible and what impacts your returns. Why should you listen to me? I've been in real estate for almost a decade now and have personally experienced everything from small, hands-on projects to large-scale commercial syndications, both as a passive and active investor. So let's dive into the numbers together. Firstly, how does real estate differ from stocks? Real estate offers steady, predictable returns through a combination of cash flow, so income from rents, and appreciation, value growth over time. And unlike the stock market, real estate typically doesn't have big daily price swings and is less influenced by investor sentiment. So remember back in 2022, when the Fed was hiking interest rates, that impacted investor sentiment of the market. And as a result, the S&P index went down by over 20% that year. So you won't see crazy swings like that in real estate typically. So again, the two main drivers in real estate for returns are: one, income generated from cash flow, and two, appreciation in property values over time. Now let's take a look at syndication, or what is commonly known as passive investing. Three key figures you want to understand are cash-on-cash returns, equity multiple, and average annual returns. So first off, cash-on-cash returns, what that is the cash that your cash invested generates. So let's say you invest $100,000 into a deal and it generates $5,000 in cash flow that year. That means your cash-on-cash return is 5% because you take the $5,000 in cash flow divided by the $100,000 you invested. So simply put, this is income you receive as a percentage of your initial investment. Typically in syndications, you can expect average cash-on-cash returns to vary around 5 to 10%. And this is great because this is cash that is paid out to you, which reduces your risk on the table. Because once the cash is in your bank account, it's yours to keep, compared to if you invest in stocks, for example. You put in $100,000, a year later it could go to $110,000, but you won't get paid out much. Maybe a few dollars from dividends, which are also taxed at a much higher rate. So the next figure is equity multiple. This is essentially how many times your money multiplies. So let's say if this particular deal gave you an equity multiple of 2 over the course of 10 years, for example, that means that your investment will double in value in 10 years. And this measure includes the cash flow that is paid out and also the back-end appreciation. And typically, you should expect to see around 1.5 to 2x equity multiple over a whole period of around 5 to 7 years. So if you invest in a deal today, you should expect it to 1.5x or 2x within 5 to 7 years. Important caveat with these numbers: when you see them, of course they're targets, they're not guaranteed returns. There's no such thing as guaranteed returns in life. Even government bonds have risks associated with them, and there is a non-0% chance that it will not hit that target. So as an investor, it's always important to know what you're walking into, what is your risk and what is your reward. Now moving on to the third metric, which is the average annual return. So this essentially measures your return over your hold period. So let's say that your investment doubles in 5 years. That's 100% growth. You divide that by 5, and then your average annual return is 20%. And typically, in this market, you should see around 12 to 20% average annual returns on your investments. Moving on, how do syndications compare to other types of real estate? So first off, let's look at single family rentals. So this is when you buy a home or a condo and rent it out. That's one of the easiest ways you can get into real estate and what a lot of people do. Typically, your cash-on-cash returns are around 4 to 6% annually. And the benefit of this is that you get to capture a lot of the long-term appreciation as real estate values generally go up over time, but you'll also be more hands-on in managing the property. And there may be some unexpected repairs that you have to factor in. Let's say the HVAC unit is broken, you need to spend another $5,000, $8,000 to repair that. So just be prepared to handle expenses like that. It's smart to generally have, call it a rainy day fund, to cover for unexpected issues like that. Similarly with small scale multifamily property, so between 2 and 4 units, you can also buy these with a residential mortgage. Your cash on cash returns will typically be better. They're around 6 to 10%. You get to manage a few more tenants than you would have with a single family rental, and that also comes with a lot more work. You're communicating with tenants. If things break down, they might call you, and if one tenant stops paying, you might have to evict them and personally go to court. Now, you could, of course, hire a property manager to handle a lot of this for you, but that would dig into your profit margin, and also they don't cover everything. And if you look into other niche asset classes like mobile home parks, which is what my team invests in, we're looking at typical cash on cash returns of 8 to 12% annually. And our returns are typically 15% or more annually due to the strong demand for this kind of housing and also lower operating costs. And this just goes to show that the riches are in the niches, because a lot fewer people invest in mobile home parks compared to single family rentals or multifamily apartments. So that's not to say that you have to invest in mobile home parks, but to find a niche that you have less competition in. Now, on these returns, obviously there's several factors that can impact your returns for any investment. And the big 4 factors are market conditions, deal structure, hold period, and operator experience. So for market conditions, this is something that's not in your control, but you can select which market you want to invest in. Let's say you invest in a market that has strong job growth and rent growth, then you should expect to see better returns as long as you buy with the right price. Second point is the deal structure. So how is the deal structured? If you're buying a small multifamily apartment, maybe you're the only one on the loan. So you're responsible for paying the bank back if there's anything wrong with the property, but you also capture all of the upside. Compared to if you're investing in a syndication, you don't have that risk with the bank. And now you also entrust management of the property to an operator group who then takes a portion of the upside. Number 3 is the hold period. Now, generally, you know, returns often improve over time as properties appreciate and rents increase. And last but not least, operator experience. It's important when you're investing passively, especially, to partner with a skilled operator that knows how to run the asset class and run those operations smoothly, because they are the ones getting the returns for you. So you want to make sure they have experience with the asset class in general, with the market, you want to see their track record, etc. It's always good to vet out these sponsors that you partner with. Now, to walk you over a quick example of a syndication investment, here's a deal that I personally invested on. So this is for a stabilized mobile home park in New Jersey. Stabilized meaning that it's at 80% or more occupancy. This is a kind of deal that I like because the majority of tenants are already in place and paying rent, and we don't have the risk of not being able to find a tenant and making loan payments, for example. So in this deal, it's a 5-year hold and it averages around 9% cash on cash. So if I put in $100,000, on average, I should expect to get $9,000 in cash flow per year. Now, of course, this would go up over time as the operations improve. So it would start at a lower amount, say $7,000. Then at the end of year 5, there is a planned sale. So that's when I would get my capital back. And the total returns for this property, we're looking at around a 2x equity multiple, average 9% cash on cash, and an average annual return of a little under 20%. This to me is far better than investing in the stock market, which averages around 7 to 10%, which barely pays any dividend. And of the little dividend it pays out, you're taxed on it. There's obviously many different benefits to investing in real estate, and I personally invest so I create a stream of cash flow for myself that can cover various living expenses, and I could become financially free, as you hear out there. I also like that real estate offers a unique balance of income and growth, and it also has tax benefits to help me pay less taxes because I'm providing a useful service to the economy. And I also like that it's more stable than stocks and that I'm not glued to my phone screen watching my stocks go up and down every day. So to summarize, real estate offers a range of returns depending on the type of investment and the structure of the deal. Syndications in particular can provide a mix of consistent income, growth, and tax benefits. And if you're considering real estate as part of your investment strategy or want to learn more, subscribe for more insights, or reach out to explore opportunities to work together. Remember, investing is about building your financial future. Not everything is right for everyone, but it's important to educate yourself so that you can make the best decision for your future.